My name is Peter Young, and I'm the CEO and Managing Director of Young & Partners. And I want to welcome all of you to this Young & Partners Forum on disruptions to the industry structure and how to adjust. I'm very excited about this because this is a very important topic, and one which has been a problem all along, but particularly, I think, a problem now. There have been so many structural changes in the last couple of years and now that it's very, very important topic for senior management to try to figure out what are those structural changes, which ones are serious and which are not serious, and then what do you do about it? How do you adjust your strategy and what you're doing in order to not only survive but to thrive. I'm really, really pleased to have as my unindicted co-conspirator, Dewey Johnson. Dewey and I have known each other and been friends for quite a long time, right, Dewey? And
yes,
he is a very important person at IHS Markit, in that a large part of the chemical practice really reports to him. And, of course, everyone knows his company. He'll talk a little bit about his background. Young & Partners is a very established independent investment bank serving the chemical and life science industries. It was formed more than 25 years ago, so we're in our 26th year, by a group of senior people and the ones who came after, who really felt that investment banking is best done in an independent fashion and boutique, where the senior people with the most experience are the ones that work with the clients but actually get the projects done. So we're sort of a reverse pyramid compared to my old firms, Solomon Brothers and Lehman Brothers and Schroders. We do pretty much all of the investment banking things except one or two things that are not money winners for anyone. And the other thing is that we do both regulatory strategy work on the life science side, which is very important because, for example, we have the former Deputy Commissioner of the FDA under the Obama administration as a senior member of our firm. And he is responsible for all medical drugs and medical devices. So that's 80% of the FDA. But we also have other people who have both operating and strategy experience and private equity experience, which allows us to help people in the intersection of investment banking and strategy. With that, let me have Dewey introduce himself, and he can explain which of the various hats he falls under these days.
Thanks, Peter. It's great to be with you, and one more time with you and sharing the conversation. So, Dewey Johnson, I'm responsible for the base chemicals research within IHS Markit. We cover roughly 200 chemicals, all the major building block chemicals in the chemical industry, as well as first, second, and tertiary order derivatives. And we have I have a team across the world, so boots on the ground. Most of my team, like myself, came from industry. I spent a number of years at Eastman Chemical Company before becoming a consultant about 12 years ago. Legacy CMEI, many of you may recognize that name. And so now, again, we have colleagues in London, Germany, Shanghai, Beijing, Singapore, Thailand, Dubai, and again, most of the folks came from industry, so have commercial backgrounds, have bought and sold chemicals, and we're pleased. Most of the folks who touch chemicals or have a line of sight to a chemical is a client, as well as the financial sector, and if you're not, we'd love for you to be a client. So. Again, we live it and breathe it every day, and my team's role is to seek to know everything there is to know about chemical and its behavior, especially from an economic performance and all the factors that affect the economic performance, including the structural supply demand and how the structure of the industry is changing. So if we don't know the answer, we'll do the research and try to respond to your needs. So pleased to be here, Peter.
So for this thing, what we thought we would do to make it interesting and informative to all of you was the following. Dewey and I will both present a handful of slides. I think I have 9 slides. Do you have 10 or 11? And where each of us, but from a different point of view, will try to capture what we think the answer is around the question that is the topic of this webcast. I'm taking more the big picture view, across all the industry and above. And Dewey is going to drill down on what's happening on the chemical side, and particularly the petrochemical side. We want to make sure, however, that there is plenty of time for discussion and Q&A at the end. At the end of our slides, Dewey and I might talk a little bit about the topic, but we also want to field questions from all of you. And the best way to do that is just to use the chat function and type in your questions. And both Dewey and I will be able to see the questions, and we'll address them. We like to start on time and end on time, so we'll try to end this promptly at the end of the hour. This is being recorded and will be available on the Younger Partners website, both as a video recording, but also if you're itching to listen to it in your car, it'll be available also as a podcast. So we drew straws, and I drew the short one, so I'm going to start. And if everyone can see the slides. So you'll see it's 10 pages, including the table of contents and title, so it's not long. But the disruptions thing is really interesting topic, and I'm going to give a little bit of a historical perspective, and then dive into also what I think is true for the industry. And in terms of the table of contents, we'll have 2 slides, which is just a background on this issue for chemicals. The second section is the big picture, which is forgetting about what industry, how do you think about this problem from a big picture point of view. Third, I'm going to go into examples of 5 or 6 structural changes that the chemical industry is undergoing currently, and explain what those are. And then last, I'll comment on, what is our recommendation to all of you in terms of how you adjust to these structural changes. So in terms of the big picture for chemicals, the reality is the chemical industry has been subject to major disruptions, and many of them in the last 10 to 20 years along many dimensions. And just to list a few of them, we all know there have been some global realignments of suppliers and supply chains. There was definitely a huge shift in cost position in terms of petrochemicals with the discovery of shale gas and oil in the United States, where, as you know, before that, everyone thought that North America was going out of business in terms of the petrochemical business industry. The third is the rise of climate change initiatives and alternatives to petrochemical style. That's definitely, we're in the midst of that, which will have a big effect. The other is geopolitical, or in markets, as so much manufacturing has shifted over to Asia and China. That really changes a lot where things are made and where you get the raw materials. Plus, now that there's a huge and now more prosperous, Chinese consumer demand, that obviously now also changes where the products are sold. Of course, near term, or since February or March of last year, we had the coronavirus pandemic, and we'll comment about, is that a long-term or short-term issue? But then financially, there are major changes in the financial and stock market position of chemical companies, as the industry was generally out of favor for a long time, and in the last 4 or 5 years is now in favor, and that's a structural change. And last, dramatic shifts in the geopolitical landscape globally, and captured by things such as trade wars, tariffs, heavy tariffs being impacted, so forth. All of these things clearly this is just a selection of the things that have hit the chemical industry in terms of structural changes. So what are the key issues today for the chemical industry? So one, we're not the only industry that has faced structural changes over time, but some of the things that are issues for the industry are, what are the recent examples that are worth raising, and what lessons can we learn from other industries? Also, what can we expect at the big picture level in the future? and what are the implications for industry players? Because after all, you could get stuck at the micro level and miss a big picture level change and get blindsided. Then what are some of the chemical industry specific structural disruptions like the ones I mentioned that are impacting? And what impact did the pandemic have on the industry, and what will be the long-term effects? And then more importantly, what have we seen chemical companies do in terms of shifting their strategies and operations to try to deal with these disruptions so that they can maintain their health and profitability? And then just as important, if not more important, looking into the future, looking farther out, what are the longer term disruptions, and what should chemical companies do to adjust to these structural changes? So looking at the big picture, I think it's worth taking a historical perspective. You know, the reality is structural changes in industries happen on a regular basis, and they've happened over many decades. And some are systematic, but some are random or unexpected, and you cannot necessarily say I could predict like such as the timing of the pandemic. There have been structural changes that have occurred for centuries in human history and in virtually every industry and affecting the lives and livelihoods of mankind. At different points in time, the prominent industry structural changes have been both positive and negative in terms of their effects on the industries involved. It's not always a negative. There could be a positive. The invention of the internet benefited a whole bunch of people in a positive way, but then it hurt people as well, in terms of the effect on their business. But what are some of the examples over the last 200 years or so? Well, first of all, we had the Industrial Revolution in the 1800s that really changed how we make things. So the assembly line, for example, was a dramatic change, et cetera. The discovery of oil and the creation of oil derivatives. I mean, we all think of oil as a given, but the reality is, until they discovered oil and could bring it out of the ground, everything was quite different. It was coal and it was wood, and a very different landscape. The invention of the computer and software, the internet, the invention of the automobile, and the discovery of biotechnology as a way to create products. These are all major innovations and structural changes over the last 200 years that produce both winners and losers. I always think that giving an example when we come to this talk of how do you deal with change, I always find that examples are very helpful. And an example that I love to give that I think all of us can relate to is the shift from videotapes and DVDs to streaming video. And what I like to do is just briefly walk through one seriously failed reaction to the change and one seriously successful reaction to that change. The failed one was Blockbuster Video. And I think most of us are old enough to remember that there were Blockbuster Video stores everywhere. I mean, every town had one. And you went in to rent tapes and then DVDs. And the management of Blockbuster Video, they just did not recognize that the sale and rental of videotapes and DVDs was going to disappear. And when volume went down, they said, well, we have all these stores, and they tried to sell tape decks and all sorts of electronics in their stores. But that wasn't really a solution, because basically, fundamentally, the whole demand was going away. And eventually they went bankrupt, and you just can't find a Blockbuster Video store anymore because they're all gone, thousands and thousands of them. So there's an example where a company could have seen the change, but either they saw it and they didn't properly assess what effect it would have on their business, or they didn't see it and they got blindsided. Now, contrast that with Netflix. Netflix, as you know, started out as a mail order DVD company. And I think many of us had Netflix accounts, and you got these mailers, and you could request a couple of movie DVDs. They would arrive, and when you're done, you would send it back, and then you were entitled to replace it with another one. And they were the dominant company in terms of DVD distribution by mail. But really early on, they aggressively and successfully cannibalized their own business to become the leader in streaming video services. And when they started doing that, people thought they were nuts. Investors were saying, wait a minute, what are you talking about? Streaming video, who knows when it's going to happen, bandwidth issues, costs. But the Netflix management said, look, it's coming anyway, and we'd rather be the leader in that and cannibalize our own business than to be destroyed. Then again, there was another shift as streaming service, the pipe became a commodity. They realized that, so they went to content, and we all know how serious they have been about that. And now they're a leader in providing streaming programming and original programming, as well as third-party programming. But again, once again, now they're going into an issue and a shift because that's becoming crowded because so many people now are offering programming. I hope they continue to be successful, but the one thing I'm confident of is they're good at figuring out when a change is going to happen, and they get ahead of the curve. So the lesson here is it's much better to be a Netflix than a Blockbuster Video. And I think the key here is just an example of, one, identifying when there's going to be a structural change, and two, figuring out how to pivot, if it's possible, in a way that you continue to be a successful company. And I love this example just because everyone can remember. Over time, people will no longer remember Blockbuster Video, but people can identify with this shift in the industry. So how about the chemical industry? So these next 3 slides are about 6 or 7 of what we think at Younger Partners are major industrial shifts in chemicals. So the first is geopolitical, where there's a geopolitical shift and a shift in manufacturing and global growth to China, right? And what are the things that came out of that? You have disruptions due to sanctions and prohibitions by governments aimed at China. So all the Trump, sanctions and banning of the use of certain companies, et cetera. You have lower global trade flows because of all these tariffs that people then impose. You have the structural issue of how the government operates in China, where now so much of the manufacturing is, because you had significantly higher business and intellectual property risks in China, because they just don't have the same level of protection for intellectual property in China that they have in the West. But the other is a big shift in the production of chemicals and products made from chemicals to China and other parts of the world. And the reality is, it's not enough to worry about the end products moving over. Even if you are a supplier of chemicals and you think you're the leader, inevitably it's going to get eroded. And I'll give you a good example. A rather well-known company bought someone's leading textile chemical business that was primarily Europe. And no question, leading market share, very high quality and so forth. But that became a huge flaw because basically, even though the business that they bought was a leader in terms of product depth, et cetera, inevitably, if they make jeans and they make all these clothes in China, inevitably you're going to lose the raw material and the textile chemical business to local folks, right? And that's really what happened. But that you could see that was coming. That wasn't an accident. It's not something that should have been a surprise. There are disruptions in supply chains and logistics that are both temporary and long-term. And that's challenging a lot of the supply source strategies that people have. And this whole thing around just-in-time manufacturing is now being questioned because the inability now to control the timing of or the availability of raw materials. And that's raising the need for domestic sources, for example. So that is causing people to have to reassess how they do business, how they make things, where they get raw materials. A hot topic is this third one, which is electronic vehicles. And there, we all can read every day how there's this prediction that we're going to shift from internal combustion cars to electronic cars globally. What effect does that have? Now, there's a debate about how quickly that really will happen, right? And obviously, the car companies are all taking different bets. But the reality is, when it happens, there are going to be a major changes. There are major changes in raw materials that are used to make cars. There's going to be a shift in where cars are being produced, and therefore, like textile chemicals, where the chemicals have to be in, to produce those cars. And then there's a reduction in the need for chemicals to support internal combustion cars. You don't need as many lubricants and things because a electric motor operates so differently from internal combustion. And then last, of course, obviously, there'll be a shift downward in the demand for gasoline. So that's a long list of things. And all the various players who are involved with producing materials, support items, maintenance chemicals, so forth, they're all going to be affected. And you need, if you're involved in somehow in that, you need to think about what's going to happen to your business and what should you do. Of course, we talked about gasoline, so we can't forget the fact that there's a major structural change in the oil industry as a result of a whole bunch of things. A reduction in demand for gasoline, a movement away from oil-based products made from oil, and an increase in renewable sources of energy and chemicals. And I know Dewey's going to talk about a little bit about this in his presentation, and it's a serious problem. And I think actually, Dewey, I think, we were chatting about this where you said, well, refineries are designed for a particular mix of products coming out. And it's a serious problem if suddenly the demand for gasoline goes down because, when you crack oil, you get a certain combination, right? And it really messes things up if the ratios change. Then there's one very important thing, which is the ESG. And there's a huge increase in the demands and requirement to follow certain environmental, social, and governance practices, and huge pressure from investors. But even if you're not a public company, there are all sorts of things you have to deal with. Now, the chemical industry is very used to environmental standards, so that isn't a big change for them. But some things are going to change, such as the insistence that you reduce the amount of your carbon footprint. There's a huge threat because the concern about the amount of plastic waste and a requirement that people say you have to be carbon neutral, et cetera. There's a long list here, including, the composition of your board of directors, what your reporting requirements are, and your access to and cost of capital. So this is a big deal thing that won't go away. And there's a real scramble to how to deal with this change. But it's going to change not just how you report things, but how you actually run your business. The third item here is the spreading use of biotechnology and renewable materials to make existing and new chemicals. And that's tied into the ESG because they're trying to get away from things that are made from oil or create pollution. And so that's going to have a big impact. And the last two things, one, of course, I want to mention the pandemic. But interestingly enough, and actually doing a chat about this yesterday, although the pandemic had a real disruption to the global economy and to a lot of things last year and this year, it's really hard to say that they're going to be long-term structural issues. And also many of them are things that were happening anyway, right? So that's our view, and were happening well before the pandemic hit. The supply chain strains, those were happening before the pandemic. The shift in demand towards China, that was happening before. So there are a lot of things that the pandemic may have accelerated the shift, but it didn't create the shift. And my last slide is, how do you adjust? And this is not a complete list, but it's just a list for you to think about. One, you should constantly assess the structural changes that are happening or likely to happen at each level, whether it's geopolitical, macroeconomic, shifting demand for products, what's being used to make your chemical, shifting technologies, trade policies, regulatory and other societal standards and practices. Be ahead of the game. Think about these in advance. Don't wait. And Don't wait for them to happen to you. Second, forecast wisely and don't always believe conventional wisdom. A lot of people, when they say this is the way it is, turns out their logic is faulty or their information is faulty. So don't always assume that someone is supposedly an expert says this is the way it's going to be. Don't assume that necessarily that'll be true. Try not to invest in businesses where the risk of a destructive structural change is significant and with no way to pivot. Formulate strategies that benefit from the structural changes and or protect you from the negative impact of structural changes. And the most important is stay ahead of the structural changes and make your moves before the changes happen, not when they have already happened. And the Netflix example of going into streaming video before anyone thought it was going to be successful is an example of making the move first, because first movers at the right time benefit. And last, pivot if you can. But if there's no way, no matter how hard you think about the problem, that you can protect yourself against a structural change, exit early. Get out early, because one, you won't suffer during a period of downturn, but the other is, if you wait too long, there may be no exit, right? And no one willing to take the business from you. So the folks who sold the textile chemical business to a well-known company, they got out, and they were very happy a couple of years later that they got out before it was obvious that it was a bad business to be in. So with that, what I'd like to do is turn it over to Dewey, who's going to go through his slides, and then we're going to start having a conversation.
Can you see my slide deck?
No.
Okay, so let's see. Let's get the technology share. Oh, here we go. Here we go.
There we go.
Okay. Well, greetings everyone again. And I have, as Peter said, 8 or 10 slides. So we're going to do a deep dive in the chemical and energy sector a bit. And a few topics that I want to hit is energy transition, greenhouse gas emissions, what the implications are of that, what are the implications to the downstream sector? Refining petchem integration, Peter referenced that, we'll talk a bit more about that. Chemicals demand, and not only the near-term robustness as we emerge from COVID, the COVID pandemic, but what's it look like long-term? And then maybe just a snapshot on the industry cycle, a little bit shorter term, but how's that behavior going to change long-term? Regional competitiveness is a critical issue, of course. It's where the margins are made, and we'll use olefins as an example. And then finally, we'll turn to sustainability and circular plastics, a critical issue. So a lot of topics, but we'll go through those pretty quickly. So first of all is for the chemical industry, it's really, we often talk about the oil to gas ratio, and it's really a critical piece. So on the left-hand side, you can see our outlook for crude. Basically, our base case is that crude oil will vary from $60 to $70 a barrel, driven by fundamentals. And natural gas, Henry Hub here is, ranges from $2.50 to $4 a million BTU. In the near term, of course, we've got, as demand rises in the near term, this is 21 time frame, there's a number of financial institutions that are suggesting crude could be $100 a barrel this year. And there is a potential for that. We have that. There's volatility around the trend line. And, the best expression of that, by the way, is OPEC plus, the price objectives of OPEC plus increase as prices go higher. I love that expression. But if you look at the oil to gas ratio on the right-hand side, it just shows that much of the chemical industry, really is affected by that ratio, with natural gas and NGLs, of course, affecting a major part of the feedstocks, and just shows that gas remains a very competitive feedstock as we look forward. I will just say the alternative case, we'll talk more about that, shows that even at a lower oil price, Gas prices decline a bit as well, but these are two disconnected markets to a large degree. That's really the point I want to make there. The other piece is around greenhouse gas emissions, critical issue. It's driving the energy transition issue. And on the left-hand side, you see pledges and how those have unfolded. Actually, 2020 and 2021 has been a leap forward for net zero pledges. And so, as you can see from the headline, 73% of global gas emissions are now covered by net zero pledges. You can see how that is unfolded on the left-hand side. And then on the right-hand side, though, it's helpful to characterize those pledges. So you can see only 10% of greenhouse gas emissions are really covered by law, and meaning there really is a strong approach of those that likely to be achieved. Another 14% or so have a long-term plan, so an operational approach of how to get there. And then we move to more aspirational aspects of targets and so forth. But the critical piece there is we have seen a significant shift in the aspirations and the goals of many countries around the world. And maybe just to characterize, as you see on the left-hand side, who the big players are. China represents 26% of the global greenhouse gas emissions. The USA is about 12%, India about 7%, the EU 27, about 7%, Indonesia 5%, Russia about 4%, and Brazil and Japan 3% each. So again, this is a significant shift, and things are happening very rapidly here. Let me then turn to refined product demand, and this is being significantly driven. We talk about energy transition, and the real aspect of that is decarbonization of the energy portfolio. And so you can see that in the as we have changed our base case, as we've gone through different iterations, 2019, 20, and 21, and each year we show a lower demand, long-term demand growth for refined products. And so our latest iteration, 2021, we're showing, as you can see, a peak of 90 million barrels per day of refined products. This does not include NGLs. So you could add another 15, 20 million barrels per day if you add the NGLs in. And then again, if you take fossil only, meaning you take out the biofuels, we show a peak around 85 million barrels per day. So those are the base case. The green rules case is our scenario where we see again, it's a scenario of a rapid decarbonization of the portfolio driven by facilitated by government policies, significant technology breakthroughs such as electrification of the fleets, continued optimization of renewables, energy and wind, and achieving this. And you can see by 2050, slightly over 50 million barrels per day of refined product demand. Significant change. This is still above, by the way, the recent IEA report, which is, as I recall, a little bit above 35 million barrels per day. But even in this green rules case, so again, we've gone through very detailed assessment of here's the kinds of things that need to occur to achieve this kind of behavior. And even in this case, it's a 1.7, 1.8 degrees C increase in temperature versus the 1.5 degree Paris Accord target. So what does that mean for chemicals? So first of all, let's talk about refining. We were talking about refined products. And we think about it in sort of four different sectors. One is around market demand. And I won't go through each of these in detail, but as you saw, we talked about a peak liquids fuel demand. We do see there will be rationalization of refining assets as some of those refiners are not really positioned to optimize, reconfigure those assets. And then there are issues around operating margins, even access to capital to make changes. They're also under government regulation, of course, the carbon emissions, net zero emissions targets, carbon tax, and how that affects the asset. We do see technology will have a major role to play here. There's crude to chemicals technology that's is actually being built, has been built in China. There's the announcements that have been made a few years ago by Aramco on initiatives in that regard. And there's multiple technologies, including advanced FCC technology, again, to shift the portfolio from gasoline and distillate to naphtha and feedstocks for petchems. And then finally, the issues around climate action and location and demographics affecting the refinery. So we talked about refined products demand. Let's talk about chemicals demand. We'll compare the two here. As you look at, so this is an aggregation of 80% of the base chemicals globally. And so you can see, this is back to Peter's comment about the pandemic and what effect that had. And so you can see the 2020 performance. We're calling it basically a year of lost growth. And then we immediately snap back to trend line. And as you may recall, for many plastics, by the way, polyolefins in particular, polyethylene, polypropylene, actually continue to see an increase in demand in 2020. Both of those major plastics are significantly in non-durable applications. So packaging, medical uses, many of the uses that were needed and really important during the pandemic period actually increased the demand for those plastics. But the real story here is, whether you look at it from a regional perspective on the left-hand side or on the right-hand side from the big value chain products, we see chemicals still continue to grow at a multiple GDP. So today, at a broad level, 1.1 to 1.2 times GDP. We see that declining closer to 1 as we go forward. And that just makes sense, pure mathematics. If the number stayed the same as the base grew, then it would be an exponential curve instead of a linear curve. So, but again, continued demand, and then the implications of that is as we are seeing major oil companies look at chemicals as a growth area. The challenge, of course, is the refined products markets are significantly larger than the chemicals market. For example, today, the refined products market is on the order of, if you look at chemicals as a percentage of the total refined products mix, it's about on the order of 7 to 8%, and it'll grow to 17% by 2050. So it'll double in size. But again, we're talking about going from nearly 8% to 17% in the 2050 timeframe. Let me just pause for a minute and look at the cycle, important area. And so if you look on the left-hand side, this is the nameplate operating rate, some of the major building blocks. You can see ethylene, a good bellwether. We're showing on a nameplate basis, ethylene going below 85%, 2023, and most of the chemicals, the industry trough is, the cyclical trough is in 2023 timeframe. A big exception to that is chlor-alkali, and you see chlorine model there. Chlorine, we believe, will continue to come into balance as we advance in time. If you look on the right-hand side, you see a very startling kind of picture, I would say, and this is the effect of the near-term disruption. So a year ago, our view of this, and this is done at a very detailed level. We do cost curves for all the major chemicals at an asset level. We do price discovery in all the geographies, and obviously from that we can calculate margins as we aggregate that across all the value chains. So previously, 2021 was a year on decline toward a pretty deep trough in 2023. And as you can see now, 2021, and we see it in the individual company earnings announcements as well, 2021 2021 has been a phenomenal year for producers if you're running. And one of the reasons 2021 has been such a good year is there have been lots of disruptions in the value chain. So the issue around, did the pandemic have an effect? It has. It's transient in nature, but critical. And let's just go through some of the disruptions. There were 2 hurricanes in the U.S. Gulf Coast. There was a freeze in the U.S. Gulf Coast that shut off much of the assets. There was the Suez Canal that was blocked earlier this year. There have been significant labor shortages for turnarounds for plants and for construction. Shipping logistics, remain challenged, especially container ships. Even today in China, I was talking to a major trader in China this week, and he was sharing, it was a shipment of polypropylene from Turkey to, from Wuhan to Shanghai to Turkey. That would normally be about a 2.5 month transit. It was going to be 5 to 6 months. It was stuck in Shanghai, anticipated for 3 months. So the shipping channels, logistics are still very, very choked up. And so the result, though, is earnings for producers is very strong. And if you look at the trough, it's much more shallow than we had. If you had looked at this at the end of last year, it appeared to be it was going to be a much deeper trough. I would just say one more element about this. One of the things that's happening that we're seeing is the construction cycle time to build plants is shortening significantly, led by China, but we're seeing that in the U.S. Gulf Coast. So the general anticipation would be, if you just do the mathematics on production's inventory dynamics, it would suggest that you can build plants quicker, they're more responsive, and perhaps it's the lags in capacity and inventory that creates cyclical behavior. So we anticipate that perhaps we could dampen the cycle going forward with this shorter lead time to build plants. Competitiveness remains an issue as well. This is just a quick look at olefins. A lot of numbers here. So Kingdom of Saudi Arabia remains ethane and propane-based cracking remains advantaged. So the bars represent geographic competitiveness for 21. The blue represents 2020, last year, and then the gray represents a snapshot of 2025. And so the marginal production is full range naphtha in Asia. And you can see as we look forward, coal to olefins and methanol olefins, especially methanol olefins, remains out of the money and will continue to be even more challenged as we go forward. So we see in 2020 that the curve was relatively flat, but as we are seeing a steeper curve in 21. And then we see an advantage, returning going forward. So we'll talk more about the competitive positioning in terms of today. This represents the conventional model of basic chemicals, meaning the industry is traditionally built where there's available low-cost feedstock and exported to the demand center. And that sort of base case remains, but there's a number of asterisks around that as we go forward, and we'll talk about that a little bit more when we turn to plastics. And so the other element that's really critical in the market is plastics and sustainability in terms of circular plastics. So I just wanted to this is a good setting, base setting graph. If you look in the right-hand side, you see the 3 polyethylenes represent about 40% of the total plastics that's consumed globally. Polypropylene is roughly another 30%. So almost 70% of plastics are the polyolefins, and the remaining are PET and PVC. If you look at the end-use segmentation on the left, you see that a lot of the conversation in the last few years has been around single-use food packaging or retail bags, which is a very small sliver of the total demand. But if you look at the end use applications, they have a short life cycle. So packaging, part of the consumer goods and part of others, you would see that over 50% of plastics, you could look at it as two ways. Over 50% of global plastics have demand risk, or another way to say that is over 50% of the plastics has the opportunity to be recycled and to have a circular, to complete the circle. And this is just a quick graph to, this is a cost curve. We've done many of these. This is just a few examples. A little bit complicated, let me explain it quickly. The 2030 curve is, again, this is cumulative production capacity on the right-hand side, on the x-axis, and then cost on the y-axis. And so the dots represent cost position on the virgin production, typical linear production for, this is a high-density polyethylene. And then the cost for mechanical recycling and chemical recycling. And so what you see is even by 2030, our calculations would indicate that chemical recycling is very cost competitive in China, low capital cost, and they can reach scale quickly. So as we go to 2050, just to take another step in time, we see a base case, the incremental case, and then an aggressive case. So what we've done is we've looked at, in these cases, looking at different levels of build on chemical recycling capacity. And we've used the experience curve. For every doubling of production capacity, I think we reduced the fixed cost by 15 to 20%. And this is based on a lot of models we've done on other chemicals in our models. So you can see is, if you go to the dotted line, the aggressive case for 2050, chemical recycling is just simply a function of building and continuing to build, increasing scale, and increasing scale leading to lower costs. So just to finish the story then on plastics, why is plastic so really important? 50% of base chemicals are consumed as a plastic. So as goes plastics, there goes chemicals. The other piece about this is it's really critical in terms of we're chasing a plane in flight, and the linear model has many years of building at world scale and optimization, and we're at the very early stages on the circular model, and we're going to have challenges to catch up. And that means that the real effect of that is all the issues around end-of-life waste problems that we have in plastics are going to get worse before they get better. And they're going to get actually quite a bit worse before they get better as we try to catch up to something that we've done very well at streamlining on the linear model. One final slide, just really summarizing some of the critical issues, and this is back to the energy transition. The role of naphtha, it's really the balancing feedstocks for pet chems, whether you're going into the olefins chain or the aromatics chain. And we see naphtha, and really understanding that is really critical, and it will transition from a byproduct of fuels to the primary product that feeds pet chems. Increasing demand for naphtha means that in order for refineries to shift, they will have to invest, move quickly from optimization to reconfiguration. That is capital, and there will need to be a return on that. The issue is then, did those investments occur at the right time to feed the insatiable appetite of chemicals? And it will likely increase margins for the refining and also increase the price of feedstocks for pet chem. And then scale of new builds will play a significant role in terms of capital costs. It will tend to, over time, increase the barriers to entry as well. And then the final thing I would say, the last bullet, is traditional refining companies will enter pet chems. We're continuing to see significant interest in that within our client base, and we'll see they'll come at different scales I mentioned, and those are likely to be disruptive both on a volume basis and on a cost basis. And with that, Peter, I'll stop sharing. You're on mute.
Although chemicals, obviously, they're inorganic, specialty, commodity, whatever, but just one, the part you're talking about is a big chunk of the chemical industry. Uh, One big picture question is this, as people have to shift, and what you're seeing is the oil guys, demand's going to go down. So where do you go? The plastics guys, there's a whole shift as to where the plastic has to end up and where people are building plants. And the Chinese are building plants, whether they make any sense or not. And then you have this the plastics recycling waste thing. There's some big disruptions that are going to happen over the next 10 years, right? And so it's going to be one of the real challenges. Where can they go, right? So oil companies, where can they go, right? That's a question, right? If they're not supposed to, with the activists, with Exxon, the 3 board seats that they had to give to the activists, and Shell having the Netherlands court telling them they've got to accelerate their movement to zero emissions, and their customers as well, right? Not just your product, but the product of your customers. It's a big problem, right? So where do you go, and where do you pivot, right? How do the oil companies pivot, and do they pivot in a way that damages the guys below them, as you're sort of suggesting, which is the guys who have been the producer of plastics, right? Then the guys in between, right, who are making plastics. Where do they pivot? Because some of these shifts could be major. It may not just be incremental shifts. There could be some major shifts in demand and who they compete with. So I guess the question is, if you were ExxonMobil and the CEO of ExxonMobil, and not headed for being Secretary of State of the United States, right? Where would you pivot? Because inevitably, all the forecasts people use say you're in trouble, right? In terms of the demand for your product. So where do the Exxons and the Shells and all those folks, where do they pivot?
Well, I mean, one of the things we are seeing is, kind of think of winners and losers. And I think one of the winning strategies is to embrace the future. And that is, there is going to be a new sustainable economy, and embrace that. And we've seen the announcement, at least the intention by ExxonMobil to employ carbon capture, utilization, and storage. And that is a critical piece of how do you leverage, carbon. I mentioned sort of this issue around competitiveness. We talked about competitiveness purely based on traditional production cost economics, but the other items that come into play now is how do governments and policymakers influence the behaviors relative to the new economy? And it could be things such as looking at mass balances on. So there's a program.
Dewey, let's go back to Exxon's problem, right? And I'll be honest with you, when you say, oh well, they can deal with carbon emissions, so forth, but that sounds a lot like the guy who made buggies. And when the cars came out, he said, I've got a solution. I'm just going to make my horses go faster, right? Because trying to just reduce the problem a little bit in terms of how they're measured doesn't solve the fundamental problem that the demand for your product is going down, right? So what do you do? And the problem is, what do you do when the only way to pivot is to pivot into something that you don't know anything about, right? Right?
Well, I would say what we have seen many oil companies are doing is embracing renewable energy. And so moving investment away from oil and into wind and solar and hydrogen, other initiatives to look at other sources of energy, biofuels, which is certainly at a very niche level at the moment. So on the energy side, we're seeing that move. On the chemical side, it's an interesting question on chemicals, because chemicals are in everyday life. They're sort of needed in everyday life. We use them in everything we do. For example, we've done a number of pressure tests on, is there a peak plastics demand? Does it bend over just like we're seeing on refined products? And you go through this deep pressure test on what must happen for this to occur. We have great difficulty finding and developing a logical, rational scenario to look at peak plastics demand. I know there's a number of publications out there that create, kind of a story, but when we drill down in a very pragmatic, quantitative way, we have trouble getting there just because plastics is very economic, and I'm neutral on this situation. Plastics is economic. It does have a good carbon footprint. But because it is so cheap, it has an end of life issue that has not been addressed by the industry.
But Dewey, just to be devil's advocate here, I don't think it's a demand issue. I think on oil, it's a demand issue, right? But I think for plastics, their problem is not whether there's demand for plastics. It's number one, will there be other ways that you make plastics that you don't know how to do, like biotech, et cetera, et cetera. So now other people are producing the plastic, not you. And the other is, even if the demand for plastic goes up, but if there's a lot of recycling, the need for virgin plastic goes down. So even if people are consuming plastics like crazy, you may not be, they may not need yours. So I think for
absolutely right.
Those plastic guys, the problem is not whether people need plastics to wrap things and so forth, although there might be some change in demand. It's who's going to supply the plastics. And the other is, includes, if there's if they find out some way to recycle more heavily, it may not be stuff that comes out of your plant.
I totally agree, Peter. I would say one thing, again, just looking at it from a dispassionate third party. For the energy transition, the energy industry talked about energy transition for 30 years before we saw an inflection point. I think we're kind of early in this phase of the chemical industry and the plastic sector. Really, there's a recognition, initiatives are underway, absolutely, but we're early in the stages of a material response that significantly moves the needle.
Well, it's going to be very interesting because the speed with which change happens, it's interesting. It's hard to predict, but sometimes in the early phase it's kind of slow and then it really accelerates, right? And there's so many examples. I mean, there used to be people who used to make cameras, dedicated cameras, and they never, you talk to the people at Sony and Kodak and all these people, they never anticipated that a cell phone would wipe out the entire demand for dedicated cameras, right? And the guys who make GPS, like TomTom and so forth, for your car, where you put it on your dashboard, they never anticipated the fact they'd become irrelevant because everyone has Google Maps on their phone, right? So when it changes, it can change, very, very dramatically. So one of the issues for the oil and the plastics guys is, one, can they pivot? Right? Or will ExxonMobil know how to make wind and so forth, just like Netflix figured out how to do streaming video, which they didn't know how to do? Or will they be like the buggy guys and just say, if I don't know how to do it, I won't do it, right?
We are seeing our sophisticated clients really embracing, looking at really trying to understand the risk and looking at scenarios that really call it black swan events, call it events that are extremely disruptive. And I think that's certainly the right kind of thing to be doing. Business as usual is kind of being blown up as we speak, right? And we're seeing across, again, the leaders of the industry looking deeply about, okay, what's this mean and how can I begin to at least, in some cases, it's a planned response, wanting to be a fast follower. By the way, I've rarely seen that strategy work, but and the other one is, how do I get on the leading edge of this?
Yeah, no, that's right. Well, I don't see any questions from the audience, so either we did a really great job or we did a terrible job. I'm not sure which, Dewey, but we have reached the end of the hour, and I do hope that the audience feels that they come away with some insights that they didn't have, when we started this webcast. And I think the one thing is true is, as you listen to the examples I talked about, or what Dewey has talked about, there's no question that we're going through a large number of structural disruptions to the chemical industry that are caused by all sorts of things, inside, outside the industry. And I think the lesson from all this is, be smart about it, figure out the structural changes before they become so serious that it's hard for you to pivot, and then pivot and pivot if you can, but if you can't, realize you're not in the right business and get out of that and be in something else. And I think that's one of the things that all of you and most of you are in attendance own chemical businesses and invest in them. So I think that's sort of the takeaway from all of this. This presentation is going to be is recorded, and it's going to be on the Young Partners website. If you want to watch it again, or you have someone who couldn't make it. And I want to thank all of you for attending, and I want to thank Dewey, who is always excellent. And we will periodically have other Young Partners Forum sessions, and we'll let you know when those happen. So thank you very much, and again, thank you, Dewey, for being a great partner in crime on this webcast.
Thank you, my pleasure. Have a great